Well, thank you, Sam. This is John speaking. Andy's going to join us a little later on during the presentation. He may jump in from time to time, especially if I trip over my tongue and end up saying something wrong and he catches me at it, and I'll return the favor for him in his portion of the program. It's really important that as the front line in your financial institution, you understand the compliance responsibilities that are incumbent upon the institution and on you as the representative of your bank or credit union. Compliance concerns, of course, deal essentially, not all the time, but most of the time with consumers. And your competent understanding of compliance issues, it can be a source of confidence for your customers. The last thing that you want to have is someone on the front line who doesn't know what he or she is doing, stumbling over compliance requirements or having to do things a second or third time with customers looking on. So the whole idea here is to make sure that that your frontline staff people have the understanding of these compliance issues so that they can do a competent job of representing your financial institution and, frankly, make sure that or minimize the potential for your institution being criticized by regulators or being sued by a customer for some compliance misstep. Now, we have a number of issues we're going to cover today, and Andy and I have attempted to kind of split them up so that we can share this presentation. Each of us, of course, comes from different backgrounds in financial institutions. Andy spent a lot more time on the lending side than I did. I spent more time on the operations side than he did. So that's sort of how we're going to divvy things up today. The things that we're going to cover are listed over on page 2 in your handouts. There are a number of issues that we'll add to that list as well. But we're going to talk about things at a fairly high level. That is, we're not going to get down into the trenches with some of the nitty-gritty questions, although if you have questions that do get down to details and you want to present them to us, we're more than happy to handle them. We just haven't covered them in the materials. We've given you enough information, I think, to give you an appreciation for the things that you need to be competent with. I sort of decided that what I wanted to do was get started with Reg CC and jump right in with one of the most complicated regulations on the operations side of the bank, and this one, of course, impacts tellers more than it impacts almost anyone else in your organization, because it's your tellers that are handling the deposits that end up being subject to this regulation CC. It's important to note that it impacts transaction accounts. In some states, like Massachusetts, where I'm from, it also covers savings accounts. You need to know what types of accounts in your institution that regulation CC does impact. But in generally speaking, across the country, everyone will find that their transaction accounts will be covered by this particular regulation. Regulation CC is a Federal Reserve regulation. It's one of those regulations that did not make the transition over to the Bureau, the Consumer Financial Protection Bureau, because for one reason or other, Congress felt that the Fed was in a better position to manage this regulation, since they are so intimately involved in the payment function and collection of checks, those few checks that continue to circulate these days. But payments are the Fed's thing and not necessarily the Bureau's thing, so Congress, in its wisdom, left it with the Fed. Now, one of the problems with the regulation is that it's woefully out of date, and we'll talk about that a little bit further on. What does the regulation do? Well, primarily, over here, we're on page 3 now. It requires that all customers get a written disclosure of your bank's expedited fund or your funds availability policy. which is a statement of how you'll handle deposits that are made primarily by check and when you'll make funds available to your customers for withdrawal. This regulation has been around for an awfully long time, and Andy and I can remember when it was first promulgated, the word got around that one of the reasons that the Expedited Funds Availability Act was passed was that members of congressional staffs were forced to put up with extraordinarily long holds when they opened up new accounts, and congressional staff tends to rotate every 2 years in the Washington area, and as a result, there were an awful lot of new accounts with people who were influential because, let's face it, staff members write laws. Congressmen and senators tend not to write the laws. The staff people tend to. And when you look at this particular law and the regulation, you'll see that it did get down and get into very much detail. So you have to give a disclosure of what your policy is. It's supposed to be done before the account is opened. Typically, this disclosure is handed out with new account disclosures like Truth in Savings and Regulation E disclosures when the account is being opened. It also sets out a general rule that when funds that are deposited electronically or by check have to be made available, as well as a number of exceptions to that rule. So basically, it lays out the limits within which your institution can set up its own policy. There are some requirements that notices be given to customers whenever the funds that they deposit will be held for longer than whatever you have told them will be normal. So if you've told them that normally it'll be available on the second business day and you decide to delay it till the seventh business day, you'll have to give them a notice. And finally, there's also some requirements in this regulation and elsewhere that you have to give notices when you've decided you're going to return a check, certain checks, that is. So there's an awful lot of details in the regulation, and many of them are not handled by frontline people, but certainly the acceptance of deposits and the placement of holds are typically handled on the teller line, about as frontline as you get in most banking organizations. There are very few differences in this regulation's handling of business accounts and consumer accounts. This particular regulation, while it's sometimes called a consumer protection rule, that's kind of a misnomer because it applies to all of your deposit accounts, all of your transaction accounts, that is, whether they're business or personal, and the disclosure requirements apply to both sets of customers as well.
Is it worth pointing out, John, that a lot of banks include savings accounts?
A lot of banks include savings accounts. Thank you, Andy. In their funds availability disclosures, even though the law doesn't require them to, as I said, in Massachusetts we have to here, but there might be a bank in Texas or a bank in Louisiana or a bank in Missouri that has decided that it's just easier to have one set of availability rules for their depositors, and they have decided that they will, on their own, include their savings accounts under their funds availability policy. If you disclose that way, then you have to act that way because you've really given your customers a sort of contractual obligation on the part of the bank to conform to what you've disclosed. Again, not because it's required, but because it may be easier to do it that way. There are a couple of definitions. There are always definitions in regulations, and there are a couple that always cause problems with respect to this regulation, and those are the definitions of business days and banking days. Business days in a lot of regulations are defined as just what you think they are, days when you are open for business. But in this regulation, a business day is defined in terms of the calendar, and not in terms of whether you're open or not.